Imagine waking up tomorrow and finding out that the economy is in trouble. Businesses are closing, companies are cutting jobs, unemployment is rising, people are spending less. So naturally, you expect one thing to happen. Prices should fall. But instead, your grocery bill gets more expensive, your rent goes up, gas costs more, and finding a job just got harder. Think about how strange that is. The economy is getting weaker, but your cost of living is getting higher. You're earning in an economy that's slowing down, while spending in an economy where almost everything costs more. And that's where things get really uncomfortable, because the people trying to fix the problem face a terrible choice. Raise interest rates to fight inflation and risk pushing the economy deeper into a slowdown. Or cut rates to help the economy and risk making inflation even worse. It's almost like driving a car that's losing speed while the engine is overheating. Step on the gas and the engine gets hotter. Hit the brakes and the car slows down even more. Welcome to stagflation. The word sounds complicated. The idea isn't. Prices keep rising while the economy struggles to grow. And once you understand what causes it, you'll understand why it's one of the hardest economic problems to fix. Because this isn't simply a story about expensive groceries. It's a story about what happens when the economy stops moving forward, but the cost of living refuses to slow down. So how does an economy get trapped in this bizarre situation? To find out, we need to follow the chain reaction from the very beginning. If you like economics explained without the jargon, subscribe to Financial Cycles. And this is where stagflation becomes really difficult. Because the central bank has a problem. It can't simply choose one side and ignore the other. If inflation is too high, the usual response is to raise interest rates. Higher rates make borrowing more expensive. Mortgages cost more. Car loans cost more. Business loans cost more. And when borrowing becomes expensive, people and businesses usually spend less. That reduces demand. And when demand cools, price increases can finally start slowing down. Sounds simple. Except there's a problem. The economy is already slowing down. So raising interest rates can make a weak economy even weaker. Imagine you're running a small business. Customers are already spending less. Your costs are already high. Now the bank tells you that borrowing money is going to cost even more. You were thinking about opening a second location. Now that idea goes straight into the drawer marked, maybe someday. You delay the expansion. You don't hire another employee. You might even cut back on your existing staff. And thousands of other businesses may make the same decision. That's how fighting inflation can put even more pressure on employment and growth. So why not do the opposite? Why not cut interest rates? Lower rates make borrowing cheaper. Businesses can invest. Consumers can spend more. The economy gets some oxygen. Great. Except, remember the inflation problem? If prices are already rising too quickly, encouraging people to spend more can add even more pressure to prices. So the central bank is stuck. Raise rates and risk hurting growth and employment. Cut rates and risk making inflation worse. It's the economic equivalent of trying to cool down a room without turning off the heater. And there's another problem. Interest rates can influence demand, but they can't produce more oil. They can't make a drought disappear. They can't magically create more electricity. And they certainly can't make a shipping container appear at a port. If the original problem is a shortage of something essential, monetary policy can only do so much. This is one of the biggest misunderstandings about inflation. People often imagine that every rise in prices is caused by people buying too much. But sometimes prices rise because the economy suddenly has less of something it desperately needs. Less energy, less food, less raw materials. And when supply falls while demand remains, prices can rise even as the economy struggles. That's why stagflation is so uncomfortable. The central bank can influence the temperature of demand, but it can't repair every broken pipe in the economy. And if policymakers push too hard in either direction, they can create a new problem. So now we have the real dilemma. How do you bring inflation down without crushing an economy that's already struggling? And to understand just how painful that balance can become, we need to leave the central bank for a moment and look at what stagflation actually does to an ordinary household. So if stagflation is this difficult to fix, how do you actually get out of it? The short answer is you have to solve two problems at the same time. You need to bring inflation under control without crushing an economy that's already struggling, and that's much harder than simply changing one number. The central bank can raise interest rates to reduce demand. That can help slow inflation. But if the economy is already weak, pushing rates too high can mean more layoffs, less investment, and an even deeper slowdown. So policymakers have to be careful. But interest rates aren't the whole solution. Remember where our problem started. If energy became expensive, if factories couldn't produce enough, if supply chains broke down, then simply making people spend less doesn't fix the underlying problem. It just makes fewer people buy the expensive products. You still have to fix the supply side. That can mean increasing energy production, improving transportation and infrastructure, making it easier for businesses to invest, reducing bottlenecks in supply chains, and helping companies produce more with the workers and resources they already have. Because there's a simple economic reality hiding underneath all of this. If you can produce more without dramatically increasing costs, prices face less upward pressure. And that gives the economy room to grow again. The government can also play a role. It can support households that are being hit hardest by rising prices. It can invest in infrastructure and energy. It can remove unnecessary barriers that make production more expensive. But there's a catch here too. If the government simply throws huge amounts of money into the economy while supply is still limited, it can increase demand without increasing production. And then, you guessed it, more pressure on prices. So even government support has to be carefully designed. This is why there is no magic button marked "Fix stagflation." If there were, economists would probably have found it by now. Instead, escaping stagflation usually requires several things to happen together. Inflation has to come down. Production has to recover. Businesses need enough confidence to invest. People need enough income to spend. And eventually, the job market needs to strengthen. It's a balancing act. Push too hard on inflation, and you can damage growth. Focus too much on growth and inflation can stay alive. Ignore the supply problem, and neither side may improve enough. And that's what makes stagflation so different from an ordinary economic slowdown. In a normal recession, policymakers can often focus on getting demand back. In a period of high inflation, they can focus on cooling demand. But stagflation asks them to do something much harder. Cool one part of the economy while keeping another part alive. And sometimes there's another ingredient that matters almost as much as policy: time. Prices don't always fall just because inflation slows. Businesses don't suddenly become confident overnight. Supply chains don't repair themselves in a week. And workers who lose their jobs don't necessarily find new ones immediately. So even when the worst is over, the effects can remain for years. Which leaves us with one final question. If stagflation can make life more expensive, weaken businesses, and complicate every decision policymakers make, how do we know when we're actually in stagflation, and not just dealing with ordinary inflation or a normal recession? That distinction matters more than you might think. So how do economists know when an economy is actually experiencing stagflation? Because not every period of high inflation is stagflation. And not every recession is stagflation either. The key is what happens to the economy at the same time. Imagine prices are rising quickly, but businesses are still growing, companies are hiring, production is increasing, people are earning more. That's inflation. Now imagine the opposite. Businesses are struggling, people are losing jobs, production is falling, but prices are barely moving or even falling. That's a recession. Stagflation is the uncomfortable middle ground. Prices keep rising while economic growth weakens, and unemployment comes under pressure. And that's why the word is so important, because the policy response can be completely different. If inflation is the main problem, policymakers can focus on cooling demand. If a recession is the main problem, they can focus on supporting demand. But if you have both problems at once, there's no easy direction to push. One of the clearest examples came in the 1970s. Oil prices surged after major disruptions in global oil markets. Energy became dramatically more expensive. And because modern economies depend on energy for almost everything, the shock spread far beyond gas stations. Transportation costs rose. Production costs rose. At the same time, economic growth weakened and unemployment increased in several major economies. The result was a combination that policymakers hated: high inflation and weak economic performance. It was a painful reminder that an economy doesn't need to be booming for prices to rise. Sometimes the economy can be struggling precisely because the things it needs to produce are becoming more expensive. And that's an important lesson. When you hear that inflation is rising, the next question shouldn't simply be, how high is inflation? You should also ask, why is it rising? Is demand too strong? Are wages and spending pushing prices higher? Or is something on the supply side breaking down? because the answer changes everything. If people are buying too much, reducing demand may help. But if energy, food, raw materials, or production capacity are the problem, reducing demand can come with a much heavier price. You might slow inflation, but also slow the economy. And that brings us back to the car we started with. A normal economy is easier to steer. If it's moving too fast, you tap the brakes. If it's moving too slowly, you press the gas. But stagflation is different. The car is losing speed, while the engine is overheating. And the driver can't simply solve one problem without thinking about the other. That's why stagflation is so difficult. It's not just that the economy is doing badly, it's that different parts of the economy are sending completely opposite signals at the same time. Prices are saying, slow down. Growth is saying, keep moving. Businesses are saying, costs are too high. Consumers are saying, we can't afford to spend more. And policymakers are sitting in the driver's seat, trying not to make the situation worse. But here's the most important question of all. If there is no perfect solution, what actually happens next? That's where the real endgame begins. So what does it actually take to escape stagflation? There isn't one perfect solution. And that's the uncomfortable truth. You can't simply press a button and make prices fall. You can't lower interest rates and expect everything to fix itself. And you can't raise rates forever without risking serious damage to the economy. The way out usually starts with getting inflation under control, while giving the economy enough room to recover. That means central banks have to be careful with interest rates. If inflation remains too high, rates may need to stay restrictive long enough to bring price growth down. But if the economy becomes dangerously weak, policymakers may eventually have room to ease. The goal isn't to make borrowing as cheap as possible, and it isn't to make borrowing as expensive as possible. The goal is to find a level that brings inflation down without unnecessarily destroying jobs. But interest rates can only do part of the job. If the original problem came from expensive energy, broken supply chains, or weak productivity, those problems have to be addressed directly. More reliable energy, better infrastructure, stronger supply chains, more investment, higher productivity. These things aren't as exciting as announcing a dramatic interest rate decision, but they're often what determines whether an economy can grow. The government can help too, but again, there is a line. Support households that genuinely need help. Invest in things that increase production. Avoid policies that simply throw more demand into an economy that is already struggling to supply it. Because if you give everyone more money while there still aren't enough goods, you may end up chasing the same prices all over again. And eventually, something else has to return. Confidence. Businesses need to believe that investing today will make sense tomorrow. People need to believe that their jobs are secure enough to spend. Workers need to believe that their incomes can keep up. When that confidence returns, the economy can begin moving forward again. And that's the strange thing about stagflation. The solution isn't simply about making prices cheaper. It's about making the economy capable of producing more and growing without inflation. Remember the car from the beginning? The economy was slowing down while the engine was overheating. The answer wasn't to floor the gas, and it wasn't to slam on the brakes. It was to fix the engine, cool it down, and then get the car moving again. That's the real challenge of stagflation. And it's also why stagflation is one of the most difficult economic problems to manage, because inflation alone is a problem, or recession alone is a problem. But when the two arrive together, you have to deal with both. And that brings us back to the question, why can prices keep rising when the economy is struggling? Because prices don't only respond to how much people want to buy, they also respond to how difficult it is to produce. When supply is squeezed hard enough, prices can rise even as growth slows. The economy finds itself stuck between rising costs and falling momentum. That's stagflation. Not simply an economy that's expensive, not simply an economy that's weak, but an economy caught between the two. And if you understand that, you can look at the next inflation report or the next interest rate decision a little differently. Because instead of asking, are prices going up? You can ask the more important question, what's actually pushing them up? If you found this video useful, don't forget to like and subscribe to Financial Cycles for more explanations of the global economy. Thanks for watching. I'll see you in the next one.